Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi.
All right, so yields are rising again, led again by the UK, maybe unsurprising at this point. As the Bank of England bought nothing in its operations, curves continue to steepen. So are you surprised by this outcome?
I'm not surprised by the market reaction that we're seeing, given that the Bank of England aren't buying very much or much at all. And I'm also not surprised by the fact that they're not buying very much. I think this tool was always designed to be a kind of backstop program. It was really, in their own words, it was a time-limited temporary operation that was essentially a circuit breaker in the gilt market to try and help markets really calm the volatility that we saw last week and help markets to regain some composure. And it really has done exactly that. We saw a monster rally on the day when it was announced, and that kind of followed through for the next couple of days as well. And although we are trending now back towards higher yields and steeper curves, as you say, that's happening in a much more orderly fashion than we saw last week. And, I think I made this point on the podcast last week as well, but for the Bank of England, it was never really about the level of yields or the fall in price that we got to in gilts. It was much more about the speed at which we were reaching that higher level. It has been our view, and I think the Bank of England share the view as well, that the level that we got to was not particularly divorced from fundamentals when you consider, the new supply outlook, given the mini budget that was announced a couple of weeks ago, what the mini budget implies for, growth and inflation expectations, and therefore what that also implies for bank rate. I think it was right that we saw yields rise quite considerably, actually, but just not perhaps with the volatility and the speed at which that was happening, particularly at the long end of the curve. And obviously, now it's been well telegraphed the problems that was creating for certain sectors of the market. I think, as is probably really always the case with these kind of programs, it's a similar story, I guess, to the ECB's TPI. These backstops are often much more, the signaling effect is often much more important than the flows effect itself. And actually, I think the Bank of England will probably be relatively content with the outcome that they have achieved. Yields have fallen quite considerably from where they were. Volatility has come off significantly in the gilt market, and actually the cost to them has been very little. They've done 7 auctions so far, if I'm counting correctly, and they've really bought less than 4 billion in terms of long end purchases, and nearly all of that was concentrated in the first 3 auctions. They did 2 in a row this week with nothing, where they bought nothing, and then they've done a final one. Not a final one, sorry, they've done one more today as we're recording this, where they bought very little. And I think that the clarification or the communication from them has been clear that they will not be bidding up for these bonds. They will not be buying bonds unnecessarily. They understand that the more they buy now, the harder it's going to be for them to sell these bonds back to the market ultimately. And so, they want to be buying as little as possible, I would say.
And so at this point, there's about 1 week left in the program. What do you think happens after they terminate it on October 14th, the scheduled end date of these temporary purchases?
Yeah, I think I'm actually a bit more relaxed, perhaps, about what happens on the 14th of October than other people that I speak to. Given that the Bank of England are buying so little right now, I'm not sure we get this real cliff edge effect that people are worried about. I think I would be more nervous if they were buying 5 billion a day. If they bought 5 billion a day for, in total, the 13 days that they were buying bonds, and that means they bought 65 billion over this period, and then suddenly we're going back to zero on Monday the 17th of October, I would be a bit more worried about the kind of volatility and market moves that would induce. But actually, given that they're buying so little, I'm not overly concerned that we'll come in on Monday the 17th and the open will be particularly chaotic. I think there's a different question around, what this means for pension schemes and whether 2.5 weeks is long enough for them to rebalance their portfolios, improve their hedge ratios, and sell down the assets that they need to sell down. But from a market functioning perspective, I actually think that given the Bank of England are buying such small amounts, and that in and of itself has generated some curve steepening and higher yield pressures, I think that what we're going to see over the next week or so is just a more measured path towards higher yields, as I was saying before, and therefore, we might end up at the same kind of end point, if you like, on Monday, the 17th of October. But actually this way, it's happening over at least kind of 7 days, if not a couple more. Whereas if they'd have been buying 5 billion a day up until Friday the 14th, we might have just had all of that move and all of that curve steepening on the Monday morning, which again would kind of perhaps put us back to square one in some ways in the problems that it might cause for the financial industry.
And finally, you briefly mentioned the mini budget, but the other news this week was that the government sort of made like a U-turn on the top rate of income tax policy. How important is that generally from signaling budget perspective?
Yeah, well, markets took it very positively. I think from a signaling perspective, they appreciated the U-turn, let's say. We saw a strong rally early on in this week, and most of that was driven by this U-turn, I think. From a kind of flows perspective, it's sort of irrelevant. The top rate of tax, abolishing that top rate of tax was estimated to cost just over 2 billion. So, as a proportion of the additional borrowing that the government announced with the mini budget, 2 billion out of that 70 billion is really small, and doesn't change the kind of net supply picture whatsoever, which was what was really the trigger for the sell-off that we've seen over the last couple of weeks. So I don't think it changes the kind of bearish view at all, or the medium-term outlook for gilts that we've held for a long time. From a fiscal perspective, it is really irrelevant. Probably enough on the UK then, because there has been other things going on this week, although it doesn't feel like it in my little world. But perhaps we can focus on the US now, Jan, because a big driver of the rally in the early part of this week that we saw, aside from the UK government reversing on one of their tax policies, was this, renewed discussion around a central bank pivot, I guess, triggered by the RBA hiking less than expected. How is this relevant for the Fed? Is the Fed pivot on, or were markets kind of getting ahead of themselves in the pricing of that theme?
Yeah, I think markets did get ahead of themselves a little bit, at least in rhetoric form. The pricing came back, it has stabilized, it hasn't entirely, markets are not, because we had this Fed's pivoting thing earlier in the summer, that didn't materialize. And I guess the main difference with the US compared to the rest, most of the other central banks, is US still shows very strong aggregate demand domestically, and a lot of the inflation is still driven domestically, as opposed to imported shocks such as energy that we're seeing for example, in Europe. So the nature of inflation is different. Data is still fairly robust in the US. We haven't fallen off a cliff by any means. So the Fed is certainly not pivoting yet. With each rate hike, of course, we're going to get closer to the peak of both signaling and what's left to be delivered. But the pivot is, I think it's, again, an overdone topic. And even from the Fed speakers, we hear similar ideas as well. But generally, I don't think we should draw too many messages from what the rest of central banks are doing. The Fed, while they does communicate with central banks globally, it doesn't really draw a path from what the rest of the world is doing. It tends to be technically in the other way around, given the relative size of the US economy compared to the rest of the world. And I guess one final thing I would say, a little bit from the Bank of England experience, I think you're absolutely right that it really depends on the speed of the change rather than the level of rates and the instability that volatility can cause into the system. US rates have been moving a decent amount, but nothing like what we saw in the UK. However, if the whole BOE intervention added one thing on the Fed's risk dashboard, I would say, is that there's a lot of systemic risks that could be building up in the background that are still not accounted for. And maybe the next time we get an acceleration in inflation, or a lack of deceleration in inflation, the Fed is not going to come out and say, listen, now we have to do 1% in hikes. Maybe they just maintain or kind of peak around these levels of signaling as opposed to pivot, which I think is a subtle but an important difference.
You mentioned Fed speakers there and kind of what they're saying. I mean, they've been pretty unanimous in their view that, the Fed will be on hold in 2023 after hiking Fed funds to around 4.5%. How does that fit with your view?
So we actually have rates going a little bit higher compared to what the latest dot plot showed. We see the cycle ending at 4.75-5% as the Fed funds range, after peaking at the end of the first half of next year. The Fed is just below that, near 4.6%. That's the median forecast. And if you listen to the Fed speakers that have been coming out, they pretty much repeat that message. We're going to get to about 4.5%. And once we get to that pretty restrictive level, we're going to stay there for a while. I think this type of messaging works for now because, like I mentioned, data is still not that bad. But once you start seeing unemployment numbers going up, once you start seeing things like services sectors showing a slowdown, which are still fairly strong, and once you kind of start seeing a little bit more political pressure, it's going to be harder and harder to persuade markets that there's 2 million, for example, there's 2 more million unemployed people, and you're still going to maintain rates into a very restrictive area. What they might be entirely different than what the market will price in. And I suppose since most people care about what the markets will price in until the end of the year, if our forecasts of a recession that begins at the end of this year actually do happen, then I think that curve will continue to invert, and people will price in more Fed cuts into next year. It's going to be very, very hard to keep pushing that story that the Fed will be able to hold after they get to a very restrictive territory into next year. So I think while in reality might end up being a little bit different, and they just might end up staying at restricted levels, the markets will have a difficult time pricing that in as soon as weakness in data starts showing up. This week was not one of those. ADP numbers just came out. They were pretty just above expectations with higher revisions last month. ISM services index, same story, shows that the services sector is still growing in absolute terms. So we'll see with the NFPs. I don't know the numbers yet for tomorrow, since we're recording this on Thursday. But so far, US still remains on a not bad of a path, I would say. This whole theme of an imminent downturn has yet to materialize, and the Fed gets away with saying no cuts next year.
What about further out the curve then? Have you, given everything that you've just said there, have you changed your view on the direction of travel of treasuries? Like you say, it's been, a volatile week with the UK leading the way, but, it's kind of swept other global fixed income with it, and treasuries have moved a fair amount as well.
Yeah, with the risk of giving the most boring most boring answer that exists out there, the treasury nominal curve looks more or less about where we have them as marked as fair value right now. The front end price is what the Fed tells you, and that's not going to change anymore. We're not going to get an explicit guidance by the Fed, a promise, so to say. They're just going to be nudging us into directions, and if they say terminal is going to be 4.6, probably market stays there. The 2-year point starts pricing some cuts afterwards, but just over 4% sounds about the right number for us for now. That further out the curve, 10s are around 3.75. We could see them gradually going lower from here, but nothing to a large extent as the Fed maintains this hawkish stance. That being said, one thing that we disagree with is the composition of the 10-year, how it's broken down between inflation expectations and real rate expectations. We think the real rate component is a little bit too high at 1.6%. On the 10-year, and inflation expectations should price in a little bit more of a premium given the uncertainty in this post-COVID world, perhaps some lingering structural inflation. This is both in the front end and in the long end. And if we assume that the Fed's long run rate estimate of 2.5% is correct, 2% of that is inflation, half a percentage point of that is real rates. And if, on the other hand, the Fed does drive the economy into a recession and in turn acts as productivity and acts as kind of like trend growth, that just makes 1.6% in real rates look a little too high. So the disagreement is mainly in the composition, but as far as yield levels go in nominal terms, pretty much the entire curve looks about right. So sorry to disappoint listeners in this really boring answer.
Okay, so let's switch over to somewhere where we think yields should actually be in quite different levels to where they are. Giles, you kind of teased us a little bit last week by saying that you were going to be updating your bund forecast. Obviously, I think we acknowledged last week that it hit your long-standing 2% target, and you have now updated that. Obviously, like I said, with the reversal of the UK's tax policy, and then with this kind of central bank pivot theme at the beginning of the week, we saw quite a big rally in fixed income, but actually now we seem to be back on this kind of bear steepening trend. So where to from here for European fixed income?
The arguments are all basically the same ones that they have been all year. I think, obviously the growth discourse has kind of come and gone a little bit, and, we are so far down the line for central bank moves and so on and so forth. But basically the fundamental kind of stack up as, what have you got? You've got a lot more bond supply, you've got larger for longer fiscal deficits, you've got the potential for quantitative tightening coming in maybe beginning of next year or something like that. I'm sure that's something that we'll come back to quite a lot in future podcasts. We've got interest rates at the front end being moved quite dramatically higher everywhere, of course, but also in Europe. And that just erodes carry. And that's, there is actually still some carry in the European curve, but that's going to go pretty quickly. And then, I won't rehash the whole discussion that we've just had with Jan in the US context, but if we're going to end up with kind of higher for longer in rates as well, then I think that those that think that long duration is a great way to have the right kind of leverage to that pivot point when rates start to fall. And so, why have catch when you can have 30-year bonds that give you 20 times leverage to that move, then great. But if that's a negative carry trade, I think that's going to try people's patience a little bit. And then you've got the whole multi-asset kind of risk reward discussion where correlations between stocks and bonds are as close to one as they've ever been, really. Global bond markets are basically risk, and so you don't have this diversification argument really in your favor either. The central bank puts, the Fed put, the ECB put, if such a thing exists, that is also a long way out of the money. So it all stacks up as a pretty bearish scenario still. And so the only thing that really matters, I guess, is have valuations done enough? And there we, the basic kind of answer is, if you're not sure, then go with the momentum given the stories. But we go back to our bund model, and that you put in. That takes into account not all of the things that I just mentioned, but a number of them, and that spits out 3% actually at the moment. And so I don't think you need to push it quite that far. I think that 275 is a reasonable target for sort of Q1 next year. That's what we're leading with. But you can stress that fair value model in a number of ways, and it seems pretty robust. 275 in most sort of reasonable alternative scenarios that you could come up with for the main inputs there is actually a lower bound rather than a midpoint or an upper bound. So 275 it is in 10-year bunds.
275, I like it. So thinking a little bit more about riskier assets, I suppose, in the context of European fixed income. The other sort of news this week, well, there's been a lot of news this week, but one thing I wanted to pick your brains on was around Italy. And we had the kind of bi-monthly PEP data this week, which showed us that actually Italy, or BTPs, weren't really very strongly supported at all by PEP purchases through August and September. Is that a surprise to you? And how do you see those spreads evolving over the next couple of weeks or months as bond yields move quite a lot higher, we think?
It's a little bit of a surprise, I think. I think it was probably a bit of a surprise to everyone, actually. They've been pretty stable around about the level where maybe people thought that the ECB might start to have some interest. And so the fact that they had that stability actually is interesting. It's a little bit encouraging, to be honest with you, to know that it seems that the ECB has not been the only game in town, and it's not the only reason why Italy has been able to maintain that stability. This week we had a number of negatives. Well, maybe I should just go back and say, over September, of course, maybe the market was just holding its breath a little bit to see what happened with these elections, which then, as we've already been over in previous podcasts, didn't turn out to be particularly scary for markets compared to expectations and so on. And they've been kind of tracking in that direction for a while anyway. So, at the moment, I don't think that there's any big changes to that story, but there were a couple of negatives. I mean, obviously, we had the risk-off kind of hit from OPEC and some bad European data. We had the sell-off resume in rates overall. We had also, there was a ratings review from Moody, which didn't take place last Friday, but they came out and said subsequently that they wanted to see reform momentum and so on, and if there was backtracking, the normal kinds of things you would expect to hear from a rating agency, then there might be some downward pressure on Italy's rating. Okay, fine. So that markets didn't love, and I think there was also some hope, perhaps. I never really thought it was that likely, but some hope that the ECB executive board member Panetta might become the next finance minister, which obviously would have given this government a particularly sort of market-friendly establishment face. So they're back in the market for a finance minister, it seems. So, a few, I would describe it as minor negatives, but I don't think the view overall on Italy has changed. And, we're now at levels in spread where, again, I think that the ECB would probably care if we widened another 10 basis points or so, particularly if I'm right and we're heading towards 2.5 or significantly higher in 10-year bunds. Then that 250 basis point spread, if we're talking about 5% in 10-year Italy, then people, I think, will start wanting to talk about debt sustainability fundamentals again in this context, but that's not quite yet.
All right, then we'll watch out for that. All right, guys, I think that's probably all we've got time for this week. Here's hoping to a little bit of a calmer and quieter week next week, but we will catch up then, of course. Thanks to our listeners for listening in, and just a reminder that if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.